there are expenses in investment management. There are expenses that you don't even know you're being charged. And I'll just use something very simple that most people have already experienced in their lives, but probably don't know how expensive it is. So a lot of people have heard of mutual funds. A mutual fund is an investment company. That investment company manages your money. And that particular company has what's called an expense ratio. So the expense ratio is a percentage of the money that you have invested. So let's just say the expense ratio is 1%. So whether you have an advisor helping you or you are doing it completely on your own, that expense ratio is taking place that you have. So if it's a 1% charge, then all of a sudden now you have this additional cost that's weighing down the cost or the results of your portfolio. So if you were actually making 7% on your investments, you really made 8 and you made 7 net. So if there's a way for us to shrink that expense ratio, then let's talk about that for a second, right? So a mutual fund has an expense ratio. There's another type of an investment called an exchange traded fund. It's an ETF. And the ETF has a lower expense ratio than a regular mutual fund, right? And the reason is because an ETF typically is what we call a passive investment. So if you think about passive investments, it's like the rising tide. All boats go up when the tide goes up, and the tide goes down, all the boats go down. Well, similarly with a passive investment strategy. There's not an active money manager in there making changes and tweaking things or buying this stock or selling that stock and moving it around. So it's less expensive to have an ETF where it's going up and down with the market. So hang in there, and if you can be patient and let it work, so that's going to be lower. I'll give you an example. There are companies, and I'm not going to mention any names, but there are companies that we work with that their expense ratio is less than 10 basis points. So that means less than 1/10 of 1%. So in that same example, if you had a mutual fund that was earning you 7% and it really was earning you 8 because they had to take the 1% out, in that ETF solution, if it also made 8%, then you would have made 7.9 instead of 7. So something as simple as picking an ETF instead of a mutual fund might provide you with a more cost-effective way to manage money. In addition, if you happen to own the stock, the actual stock that's inside of a mutual fund instead of owning the mutual fund, then that individual stock has an expense ratio of 0. So most people are like, well, I'm not sure I can pick the stock. I'm a little bit concerned about picking that stock. I don't know which one to pick. So that's why you have a professional help you. But those expense ratios, sometimes they'll charge you a fee to do the work, the managers or the investment professionals, and then the manager of the mutual fund will charge you a fee. So that ends up being more like 2% instead of 1% or whatever they're charging you. So an ETF can be a more cost-effective way to manage money, and you can buy them kind of in a more of a broad type of investment spectrum so that you get exposure to different markets. So mutual fund is, and there's all sorts of reasons why we say mutual funds are not good. There are some that are also good, like you can get in for a very low amount of money. That's a good thing. But mutual funds are tax inefficient. So if you're in a high tax bracket, you probably don't want to be in a mutual fund because they're not as efficient as owning the individual stock. So if somebody were to sell the stock inside the mutual fund, you get that tax ramification you have to pay whether you sell the mutual fund or don't sell the mutual fund. Those are called capital gains distributions. Those typically happen in the fourth quarter of every year. So there's a lot of different examples of how you can be more cost effective. That's one of the things that we look at in our firm, is how cost effective is the investment solution for this Mr. and Mrs. client. And so if we can reduce the expense ratio or eliminate the expense ratio, then all of a sudden it's almost the same cost to have us working for them in implementing that part of their plan as it would be as if they went out and just bought a mutual fund on their own and paid the fees.